In less than 4 days, we are going to see the Federal Reserve make their decision to cut interest rates. It seems like it's almost a certainty that this is going to happen. And in fact, if you look at the markets and the odds, it's nearly 100% chance that this is going to happen, at least 25 basis points. But the interesting part of all of this is not that the Fed is going to cut interest rates, but it's how similar it looks to a very, very drastic period in our economy, similar to the 1970s. And what happened in the 1970s? Well, I will get into all of that here later today. But first, we're going to dive into what this could potentially mean here as it goes for cutting interest rates. Because right now, the Fed is going to blame a weak labor market. But this will be just the third year since 96 the Fed will cut interest rates while the S&P 500 is at record highs. So for those of you guys who have been sticking around with me, know that I went over this yesterday, so make sure you're hitting the subscribe button. But the S&P 500 rallied above 6,600 for the first time in history, up 36% since that April bottom, which is literally the best 5-month rally in United States history. So the U.S. stock valuations hit its highest level on record, surpassing the dot-com bubble and the 1929 peak before the Great Depression. So as you guys know, I've been screaming from the top of my lungs that I believe we're in an asset bubble here. And this highlights just that. Now, it's not necessarily like, all right, the bubble is going to burst. But what we are seeing is that the asset prices are just heavily, heavily inflated because of the underlying fiat currency we have. Now, will this mean bad things are ahead? I don't think in the near term we're going to see some things, but in the long term, we might see some periods of stagflation. We're going to go over that a little bit later, but seeing this, it's justified as the world experienced its biggest technological revolution in 20 years, or at least that's what they say, right? But the interesting thing is that typically the Fed cuts interest rates when we have a weak economy, but the strength is allegedly at 3% GDP growth year over year. So inflation data is running hot, and core CPI and all of these other metrics are still increasing. And I think that, in my personal opinion, we don't see that inflation is coming down just yet. And so because inflation is not coming down, I think that cutting interest rates during this time is a little, let's call it premature here. But we're going to keep diving in to some of the similarities we see from the 1970s as we see here. But first, we'll get over the labor market, right? The cracking, the forcing the Fed to cut the interest rates. They're saying that there's plentiful decline to 34.1%, the lowest since 21. This is down 22 points, over the last 2 years. So labor market's going down, GDP is going up, S&P is going crazy. So the S&P 500, when the Fed cuts 2% of all-time highs, the S&P loves it. So that's probably what's going to happen. We're probably going to see the S&P 500 rally like crazy and continue this generational run that it's on. So I think asset prices are going to continue to run hot. But something interesting, because they said since 1980, 100% of the Fed rate cuts with S&P 500 record highs have led to record highs 12 months later. Not to mention this time around, we are in the midst of an AI revolution. Mag 7 investing $100 billion per quarter. The biggest technological revolution. But the interesting thing is Apollo on these rate cuts said that it looks similar to the 1970s. And look at how close these lines are here. It almost seems like you're drawing the same exact pattern here when you line them up like this. So it's eerily similar to the 1970s. Now, what happened in the 1970s economy? Well, it was defined by stagflation, a combination of high inflation, high unemployment with slow economic growth, which ended the post-World War II economic boom. So we're watching this and saying, hey, you know what? This could be another case of just stagflation. But remember, what WTF happened in 1971? This is a great website, folks. You could always see the differences in the economies and the changes we saw once we went off that gold standard in 1971. I mean, if you look at real GDP and wages, they changed the calculations, incomes, all these things. It could essentially lead back to just one event in history, 1971, and then boom. So many changes going left and right. So I encourage you guys to go to that. But let's get back to the point at hand. The stagflation in the 1970s, unemployment was a period of both high inflation and uneven economic growth with high budget deficits, lower interest rates, the oil embargo, the collapse of managed currency rates. And Volcker prime lending rate was above 21% to reduce inflation. So Volcker was the higher for longer that we heard from Powell. And then, we do see friend of the program, George Gammon, tweeting this out, that the initial jobs claim was 263,000 and CPI at 2.9%. So it looks like we're going to cut interest rates, right? But this time period, looking eerily similar to the 1970s, is not exactly a positive because the 1970s did not have massive amounts of economic growth. So when we're looking at, a 93.4% chance to cut at least 25 basis points, and then a potential 6.6 to cut 50 basis points or more, I mean, we're looking at the potential of, stagflation running crazy. And this is where, when you see a weak dollar, the Dixie having one of the worst starts in 50 years, I mean, literally, it's comparable to 1973, the start of this year on the Dixie and the dollar index. So literally too many things are being compared to the 1970s right now, where it's looking like stagflation is an all but certainty. Now, the only saving grace that we potentially have here is that we could see these interest rate cuts come and provide an economic boom. They could provide this AI revolution that we're seeing. They could add a little bit more fuel to that fire. That's the only interesting aspect of this. But if you look at the immediate 30-day results after cutting interest rates, it falls the next month. So even though we potentially might see this economic boom come from cutting interest rates, and we've seen the market price it in, we might actually see a little bit of a rundown here. And I think that's what not a lot of people are anticipating. I think, honestly, if we see a 25 basis point cut on Wednesday and not a 50, we're going to see that market drop a bit because people are really looking for the market to cut 50 basis points. I mean, I'm pretty sure these 3 rate cuts are priced in right now. So if 3 rate cuts are priced in, and we're, not looking like we're going to be on that pace, well, we're not going to see the market shoot up, even though we've seen this previously, right? Even though this is something that, you kind of tend to see. So this time around, expect a similar outcome is what they're saying. So it's not just me saying that, not just this talking head here. But there's going to be immediate term volatility, but long-term asset owners will party because interest rates cuts are coming, rising into inflation and the AI revolution. Now, gold and Bitcoin as well tend to, let's call it, party in this in this inflationary environment as well. So I think this is going to be something that we got to keep a very close eye on, because these hard assets, traditional inflation hedges that we tend to see, those are usually skyrocketing in flight. And when we've seen gold basically be on like a generational run for, you know, all time, literally the best 5-month rally in history, well, this is going to continue, right? This is something that we're seeing gold actually outperform the S&P 500 for the first time in a long time. And so now that the Fed is going to cut interest rates and inflation is still running hot, we are still going to see gold crush. And like McLovin in the chat is saying, RIP to those wage earners. Exactly, because wages aren't going up. And, I've been covering the jobs market and how these revisions have just been absolutely drastic and something that we've never seen before. Literally 1 million jobs just poof, vanished, gone. Now, why is that? Well, because the economic data that we use is just survey data. It's not quality data. And then we're making massive amounts of decisions based on this. It does not make any sense whatsoever. And we have stagflation potentially here. And with stagflation, you got to watch out with where it's going, right? Because the economy is not going to be growing from this. Now, if the economy is not going to be growing and we see, some of the negative layover effects of this stagflation come, well, this is going to be a difficult pill to swallow for a lot of, the economy, even though we're going to see the rich get richer with asset prices inflating. So we're going to be keeping a close eye on this as we are hitting all-time highs in the S&P 500. Gold's hitting all-time highs, and I'm sure Bitcoin will start to hit all-time highs here pretty soon as well, because assets are going to keep doing what they do, but these rate cuts it's looking awfully similar to the 1970s with a massive period of stagflation. So make sure you guys are smoking that like Cheech and Chong, hitting the subscribe button for me, telling a friend to tell a friend, and I'll catch you guys all tomorrow.